Hey, welcome back. So in a previous video, we talked about how to start investing with just $100, and I mentioned something called an ETF. And based on the comments and questions I've been seeing, a lot of you want to know more. What exactly is an ETF? How does it work? And most importantly, should you be putting your money into one? Today, we're going deep on ETFs. By the end of this video, you're going to understand exactly what they are, why they're one of the most powerful investment tools available to everyday people, and how to pick the right one for you. Let's get into it. So first, what does ETF even stand for? It stands for Exchange Traded Fund. I know, not exactly the most exciting name, but what it means in plain English is this. An ETF is a basket of investments that you can buy and sell on the stock market just like a regular stock. Think about it this way. Imagine you wanted to invest in the top 500 companies in America. Apple, Microsoft, Amazon, Google, Tesla, all of them. But buying individual shares of every single one of those companies would cost you tens of thousands of dollars and take forever to manage. An ETF solves that problem completely. Instead of buying each company separately, you buy one single ETF and instantly own a tiny piece of all of them. One purchase. Instant diversification. That's the magic of an ETF. Now here's something that surprises a lot of beginners. ETFs are not new. They've been around since the early 1990s, and today there are over 8,000 ETFs available in the US market alone. They hold trillions of dollars in assets. We're talking about one of the most widely used investment vehicles on the planet, and most people have no idea how they work. So let's break down the three main things you need to understand about ETFs. Number one, how ETFs are structured. When you buy an ETF, you're buying shares in a fund that holds a collection of assets. Those assets could be stocks, bonds, commodities, or a mix of all three. The fund is managed by a company like Vanguard, BlackRock, or State Street, and they handle all the buying and selling of the underlying assets for you. You just own shares in the fund. Simple. Number two, the cost. This is where ETFs really shine compared to other investment options. ETFs have what's called an expense ratio, basically the annual fee you pay to own the fund. And for most index ETFs, that fee is incredibly low. We're talking as little as 0.03% per year. That means on a $10,000 investment, you're paying just $3 a year in fees. Compare that to actively managed mutual funds, which can charge 1 to 2% annually. That's $100 to $200 on the same investment. Over decades, that difference in fees compounds into tens of thousands of dollars. Low fees matter more than most people realize. Number three, the types of ETFs. Not all ETFs are the same, and this is where beginners sometimes get confused. The most common type is an index ETF. This tracks a specific market index like the S&P 500 or the total US stock market. These are passive, low cost, and historically very reliable. Then you have sector ETFs, which focus on specific industries like technology, healthcare, or energy. These are higher risk because you're concentrated in one area. And then there are bond ETFs, international ETFs, dividend ETFs, and more. For most beginners, starting with a broad index ETF is the smartest move. Now let's talk about the two ETFs that come up most often for beginners: VOO and VTI. You've probably heard these names before. VOO tracks the S&P 500, the 500 largest companies in the US. When people say the market went up today, they're usually talking about the S&P 500. Buying VOO means you own a piece of all 500 of those companies in one shot. VTI goes even broader. It tracks the entire US stock market, including small, mid, and large cap companies, over 3,000 companies in one fund. Both are managed by Vanguard, both have extremely low expense ratios, and both have historically delivered strong long-term returns. If you're just getting started and you're not sure which one to pick, either one is a solid choice. The difference between them is smaller than most people think. Here's the bottom line on ETFs. They were essentially designed for people like us, everyday investors who don't have time to research hundreds of individual stocks, who want low fees, and who want to participate in the growth of the overall market without taking on unnecessary risk. Warren Buffett himself has said that for most people, a low-cost index fund is the best investment they can make. That's not a coincidence. Here's your action step for this week. Log into your brokerage account, the one you opened after watching our last video. Search for either VOO or VTI. Look at the expense ratio, look at the historical performance chart, and if you haven't already made your first purchase, do it today. Even if it's just one share, you don't need to wait for the perfect moment. The best time to start is now. If this video helped you understand ETFs better, hit subscribe. We break down exactly these kinds of topics every single week, so you can build real knowledge and real wealth without the confusion. I'll see you in the next one.